It begins deceptively, almost innocuously. A trader sits before their glowing screen, eyes locked on the flickering candlesticks that weave stories of profit and loss across the chart. Their pulse quickens as numbers pulse, prices shift, and the market hums with possibility. At first, trading feels conquerable, a puzzle to be solved with a handful of rules, a few well-rehearsed strategies, and a dash of intuition. The promise of wealth seems tantalizingly close, just a trade or two away. Yet by the week's end, the same trader stares at their account in stunned disbelief. Half their capital has evaporated, the remaining balance teetering on the brink of ruin. What went so catastrophically wrong? What unseen force unraveled their meticulously crafted trades into a financial wreck? The answer is not found in the market's volatility, faulty indicators, or even a stroke of bad luck. The harsh reality is that most traders don't fail because of external factors. They fail because of a silent, insidious destroyer lurking within. The #1 mental mistake that obliterates trading accounts: emotional decision-making. Before we continue, make this commitment. This channel isn't about quick fixes. It's about developing traders with mental strength and discipline. If that resonates with you, join us. Subscribe now so you don't miss any of our upcoming videos. Stay until the end and keep progressing with us. One mindset shift at a time. This video isn't just another trading video, it's a mirror for your mindset. Like now, comment what resonates and stay until the end. Because one idea here could change how you think and how you trade. Let's go. This mistake isn't as overt as selecting an unreliable broker or misplacing a stop loss. It's far more insidious, residing deep within the trader's psyche, infiltrating every choice, waiting for a moment of weakness to strike. Emotional decision-making is a predator cloaked in the guise of instinct, masquerading as confidence, intuition, or a gut feeling. To grasp its destructive power, we must first dissect its mechanics and understand how it sabotages even the most promising traders. The nature of emotional decision-making. Emotional decision-making is a wolf in sheep's clothing, presenting itself as a trader's ally while quietly undermining their discipline. In the early stages, it feels exhilarating. A trade moves in your favor, and a surge of euphoria washes over you, reinforcing the belief that you're in control. Your brain, flooded with dopamine, interprets this rush as evidence of skill, not chance. You feel invincible, as if the market is bending to your will. But markets are fickle, and when they turn, because they always do, those same emotions that once empowered you become shackles. They pull you into reckless trades, urge you to double down on losing positions, and blind you to your own errors. The market doesn't need to outsmart you. Your emotions do it for free. Consider Emma, a trader I mentored last year. She began with a modest $2,000 account and a straightforward strategy: buy at support levels, sell at resistance, and risk no more than 2% of her capital per trade. Her approach was disciplined, her analysis thorough, her execution cautious. For weeks, she adhered to her plan, building steady gains. Then came a day when she spotted what she described as the perfect setup. Her confidence soared, and she convinced herself she could outsmart her own rules. Ignoring her predetermined stop-loss, she entered the trade with unwavering certainty. 5 minutes later, the market turned against her. Instead of cutting her losses, she doubled her position, desperate to recover. By the day's end, half her account was gone. When we debriefed, the root cause was clear. Emma had abandoned her strategy, letting her emotions take the wheel. The many faces of emotional decision-making. Emotional decision-making wears many masks, each more deceptive than the last. The primary culprits are fear, greed, hope, revenge, and overconfidence, each capable of derailing even the most robust trading plan. Let's explore these emotions in depth to understand how they manifest and why they're so dangerous. Fear is often the first emotion new traders grapple with. Picture this: you open a position and almost instantly the price dips against you. Your heart races, adrenaline spikes, and cortisol floods your system, hijacking rational thought. Your strategy might dictate waiting for a predefined stop loss, but fear screams for immediate action. You close the trade prematurely, not because the chart demands it, but because your body is in panic mode. This is the irony of fear. In evolutionary terms, it's designed to protect you from physical danger, like a predator in the wild. In trading, however, it becomes a predator preying on your capital. Fear-driven exits rob you of potential winners, while fear-driven avoidance keeps you from entering promising trades altogether. Greed, on the other hand, operates in the opposite direction, but is equally destructive. While fear prompts early exits, greed tempts you to overstay your welcome or chase risky opportunities. Take John, a trader with a $5,000 account. He was up $200 on a trade, a solid win by his plan's standards. Instead of locking in the profit, greed whispered, "Hold on a bit longer. You could turn this into $1,000. That whisper became a shout as he watched the price climb, only to see it reverse sharply, wiping out his gains and dipping into his capital. Greed seduces with promises of quick riches, but punishes with relentless precision when it drives your decisions. Hope and revenge are subtler, but no less dangerous. Hope disguises itself as patience, convincing you that a losing trade will come back if you just wait. You might tell yourself the market usually rebounds at this level, ignoring the statistical reality that past patterns don't guarantee future outcomes. Revenge, meanwhile, creeps in after a loss, urging you to make it back with an impulsive trade. It's the voice that says, "This time will be different. You'll win no matter what." Both emotions bypass logic, risk management, and strategy, replacing them with wishful thinking. Overconfidence is perhaps the most insidious because it's the hardest to detect. A string of early wins can make you feel untouchable, as if the market is yours to command. You start skipping analysis, ignoring rules, and underestimating risks, convinced you've cracked the code. Overconfidence doesn't just lead to losses. It blinds you to your own fallibility, making recovery slower and more painful. A trader with a $10,000 account riding a wave of overconfidence might risk $500 on a single trade, believing the market will conform to their expectations. When it doesn't, the financial and emotional fallout is devastating. The common thread among these emotions is their ability to override your trading plan. Stop losses are ignored, risk percentages are violated, and trades are entered impulsively. Each time this happens, your account takes a hit, not because of the market, but because you've allowed emotions to dictate your actions, combating the silent killer. The first step to overcoming emotional decision-making is awareness. Recognizing that every emotionally driven choice is a step toward disaster lays the foundation for change. Awareness alone won't eliminate the problem, but it's the starting point for building systems to counteract it. One powerful system is pre-commitment. Before entering a trade, write down your entry point, exit strategy, and risk parameters. Treat this document as a binding contract with yourself. When emotions surge, whether it's fear urging you to exit early or greed tempting you to hold longer, refer back to your plan. This simple act anchors you to logic, reducing the likelihood of impulsive decisions. For example, a trader might commit to risking no more than 1% of their account on any trade, with a stop-loss set at a specific price level. When the market moves against them, the written plan serves as a reminder to act rationally, not emotionally. Another critical tool is journaling. Beyond logging trade outcomes, record the emotions and thoughts you experience before, during, and after each trade. Over time, this practice reveals patterns. You might notice that fear spikes during volatile market hours, or greed surfaces after a string of wins. Identifying these triggers allows you to anticipate and manage them. For instance, Alex, a trader I coached for 6 months, struggled with fear and revenge trading. His account swung wildly, Up 20%, down 15%, up 10%, down 25%. When we introduced pre-commitment and emotional journaling, the results were transformative. He began adhering to his plan even during market downturns, stopped revenge trading, and cut losses early. Within 3 months, his equity curve stabilized, and he regained control over his decision-making process, channeling emotions, not eliminating them. Emotional mastery in trading isn't about suppressing feelings, it's about channeling them constructively. The thrill of a winning trade can fuel motivation if it doesn't lead to recklessness. The fear of loss can prompt you to double-check your analysis, reinforcing discipline rather than undermining it. Think of emotions as indicators, not decision-makers. They signal potential risks or opportunities, but should never drive the trade itself. The trading environment also plays a critical role. Fatigue, stress, or distractions amplify emotional mistakes. A trader operating on little sleep or under personal pressure is far more likely to succumb to fear or greed than one in a calm, focused state. Professional traders treat their mental and physical well-being as integral to their strategy. Adequate sleep, regular breaks, balanced nutrition, and even mindfulness practices like meditation become tools for maintaining emotional clarity. For example, a trader who skips lunch and trades late into the night is more likely to make impulsive decisions than one who maintains a structured routine. The role of leverage is another factor that magnifies emotional responses. High leverage amplifies not just gains and losses, but the psychological weight of each trade. A $500 loss on a $5,000 account feels manageable, but the same loss on a $500 account, amplified by leverage, can trigger panic and irrational decisions. Respecting leverage is as much a mental discipline as a financial one. Traders must understand that high leverage doesn't just increase risk. It intensifies the emotional stakes, making it harder to stick to a plan. The market's brutal honesty. The market is a merciless teacher designed to expose and exploit emotional weaknesses. Its short-term randomness and unpredictability are not flaws, but features, ensuring that only those with disciplined minds survive. Emotional decision-making undermines the one thing you can control: your actions. No trader is immune, not beginners, not professionals. The difference lies in how successful traders respond. They don't eliminate emotions. They manage them through systems, awareness, and relentless self-review. Consider Ryan, a trader who seemed to have everything figured out. He studied countless strategies, backtested systems for weeks, and crafted detailed risk management plans. On paper, he was poised for success. Yet month after month, his account told a different story, promising gains, followed by devastating losses. The culprit? Habitual, emotional behavior. Small lapses, hesitating to enter a trade, delaying profits, or refusing to cut losses, compounded over time, turning a disciplined trader into a victim of his own mind. The hesitation loop and overreaction spiral. One of the most common emotional patterns is the hesitation loop. You identify a textbook trade setup, indicators aligned, risk calculated, but something holds you back. Perhaps it's fear of loss or self-doubt about your analysis. You wait, watching the market move without you. By the time you act, the opportunity has passed, or you enter late, increasing your risk. This loop erodes consistency and chips away at confidence, leaving you second-guessing every decision. Equally destructive is the overreaction spiral. A single loss triggers an emotional shift from disciplined trading to survival mode. Instead of reviewing the loss objectively, you chase the next trade to make it back. This is classic revenge trading, where one impulsive decision can erase weeks of careful gains. For example, Maria, with a $3,000 account, followed a strict 2% risk rule for weeks, growing her capital steadily. Then a single losing trade sparked panic. Instead of accepting the loss, she doubled her next trade size, hoping to recover. That decision wiped out half her account, not because of the market, but because of her emotional reaction, the neurological roots. These patterns have deep neurological roots. The human brain is wired to seek rewards and avoid pain, a survival mechanism that clashes with trading's demands. A winning trade triggers a dopamine rush, urging you to chase more. A loss triggers fear and stress, pushing you to act irrationally to escape discomfort. This tug-of-war between reward-seeking and loss aversion explains why even the best strategies fail without emotional discipline. To break these cycles, start with recognition. When you feel hesitation, panic, or the urge to chase losses, pause and label the emotion. Naming it, fear, greed, hope, reduces its grip, allowing you to observe rather than react. Next, establish mechanical rules to bypass emotion. For example, I will not enter a trade outside my predefined setups, or I will never risk more than 2% per trade. These rules act as guardrails, keeping you on track when emotions surge. Journaling remains a cornerstone of emotional discipline. Record not just trade outcomes, but the thoughts and feelings surrounding them. Over time, you'll identify triggers, specific market conditions, times of day, or personal stresses that heighten emotional risk. Ryan, after months of erratic trading, adopted emotional journaling. He noticed that losses often followed hesitant entries or attempts to recover quickly from prior losses. Armed with this insight, he implemented a pre-trade checklist, fixed risk limits, and a no-revenge trading rule. Within 3 months, his account stabilized, and he began posting consistent gains. The compounding effect of micro-decisions, emotional mistakes, compound through micro-decisions. Holding a trade too long, entering too early, or risking too much may seem minor in isolation, but over time these lapses snowball into significant losses. Traders often focus on catastrophic mistakes, but it's the small, repeated emotional errors that do the most damage. For example, moving a stop-loss just a little in one trade makes it easier to do so in the next. Before long, you're risking far more than planned, trapped in a cycle of escalating mistakes. Confirmation bias further exacerbates emotional errors. Traders naturally seek evidence that supports their beliefs while ignoring contradictory signals. You might spot a setup and focus only on confirming indicators, dismissing red flags like overbought conditions or news events. This bias amplifies risk, as you're not trading the full reality of the market. To counter this, adopt a pre-mortem mindset. Before entering a trade, imagine it failing and visualize every possible reason why. This exercise prepares you for adverse outcomes, reducing the likelihood of emotional derailment. The role of environment and leverage. The trading environment silently influences emotional control. Fatigue, stress, or distractions, like trading during a chaotic day or after a sleepless night, heighten the risk of impulsive decisions. Professional traders prioritize mental and physical health, recognizing that a clear mind is as critical as a sound strategy. Simple practices like taking breaks, eating well, or meditating can significantly reduce emotional volatility. Leverage, too, plays a pivotal role. High leverage doesn't just amplify financial outcomes, it intensifies emotional reactions. A $500 loss on a $5,000 account feels different when leverage magnifies it to a $500 loss on a $500 account. The psychological weight of such losses can push traders into survival mode, where rational decisions become nearly impossible. Treating leverage with respect is a mental discipline, requiring you to size positions conservatively to preserve emotional clarity. The illusion of control. At its core, emotional decision-making stems from a deeper flaw, the illusion of control. Traders often believe they can bend the market to their will, whether by holding a losing trade longer in hopes of a reversal or chasing a winning streak to maximize profits. This illusion feels empowering, but is pure self-sabotage. The market is driven by global forces, trillions in capital, institutional strategies, and unpredictable events, not by your willpower or analysis. Believing you can control outcomes sets you up for failure. The illusion of control is particularly dangerous because it's reinforced by random wins. Imagine doubling down on a losing trade, only for the market to bounce back. You feel like a genius, but you've been rewarded for reckless behavior. This creates a feedback loop where you associate breaking rules with success, paving the way for larger losses when luck runs out. Professional traders measure success by adherence to their plan, not by the outcome of a single trade. A losing trade executed correctly is a victory. A winning trade that violates rules is a failure, regardless of profit. Accepting randomness, another layer of emotional decision-making, is the refusal to accept randomness. Humans are pattern-seeking creatures, wired to find meaning in chaos. In trading, this instinct leads to over-analysis, where every candlestick or price movement is assigned a narrative. But the market is inherently noisy, with many movements, driven by random order flow, rather than grand conspiracies or economic shifts. Mistaking randomness for predictability is a recipe for disaster. Consider EUR/USD climbing steadily one morning. A trader might attribute it to central bank signals or institutional buying, spending hours crafting a story that justifies their trade. In reality, it could be a fleeting surge of buy orders with no deeper meaning. By chasing this illusion, the trader misses the real opportunity or enters late, increasing risk. Accepting randomness means embracing probability over certainty. The best traders don't predict every move. They manage risk to survive the market's unpredictability. In 1987, during the Black Monday crash, traders who clung to the illusion of predictability were wiped out. Those who survived didn't foresee the crash but accepted that extreme randomness was possible. Their stop losses, conservative position sizing, and disciplined mindset allowed them to weather the storm. The lesson: survival is the ultimate edge, and it comes from respecting the market's chaotic nature. The spiral effect. The most destructive manifestation of emotional decision-making is the spiral effect, where emotional mistakes become the trader's default mode. At this stage, fear, greed, or ego filter every decision, turning trading into an emotional battle rather than a strategic one. The spiral feels normal, even productive, as traders double their screen time, increase lot sizes, or pile on indicators, convinced that more effort equals success. But in trading, effort is measured in clarity, not intensity. The spiral thrives on denial. Traders hide losses, post only their wins on social media, and avoid confronting their mistakes. This silence prevents growth as they never address the root cause, their own psychology. Breaking the spiral requires brutal honesty, acknowledging that the problem lies within, not in the market or strategy. It's not about adding more knowledge. Most traders already know what to do. It's about executing that knowledge consistently, even under emotional pressure. Breaking free to escape the spiral, start with awareness. Recognize the moment emotions begin to override logic, whether it's hesitation, panic, or the urge to recover losses. Pause, name the emotion, and refer to your pre-commitment plan. Mechanical rules like fixed risk percentages or a no-revenge trading policy act as guardrails. Journaling helps identify triggers, while a controlled environment, free from fatigue or distractions, supports rational decision-making. The market is a mirror, reflecting your psychological strengths and weaknesses. It doesn't reward ego, control-seeking, or the need to be right. It rewards patience, discipline, and detachment. The traders who thrive aren't the smartest or most analytical. They're the ones who master themselves. They accept losses as part of the game, view randomness as a feature, and measure success by consistency, not single trades. The path forward. The number one mental mistake, emotional decision-making, is a constant threat, lurking in every trader's mind. It manifests as fear, greed, hope, revenge, or overconfidence, each capable of derailing your plan. But with awareness, systems, and discipline, it can be neutralized. Pre-commitment, journaling, environmental control, and respect for leverage are your weapons. Use them to protect your capital and position yourself for consistent gains. The market doesn't destroy traders. Traders destroy themselves by failing to master their emotions. The spiral effect, where emotional mistakes become habitual, is the final stage of this destruction. But it's not inevitable. By recognizing emotional triggers, implementing mechanical rules, and embracing randomness, you can break free. The path to consistent trading isn't about predicting the market perfectly. It's about controlling the one variable you can: yourself. If this resonates, reflect on your own trading. What emotion, fear, greed, or the need to be right causes you the most damage? Share your thoughts, and let's dive deeper into mastering the mind, the true battlefield of trading.